Let's get to it, man.
Awesome. Yeah. Thank you for the intro. First of all, can everyone hear me? I know I'm not on camera right now. It's not necessarily cooperating with me here. So if you're lucky enough to meet me at the booth, you know what I look like. If not, maybe I'll see you next year. But yeah, thank you so much for the time here being with you all today. So just to kind of review and go over National Life and where we're going to be a strong fit for your business. We're the first company ever to offer a living benefits on our product. So that's something you've probably heard about from National Life. Plus, we have those living benefits in all 50 states. Paid out claims during the Titanic, and we've been around since 1848. So we're a very strong mutual company that's been around for a long time. We are 100% mutual. So being financially strong, as you guys might have heard at the convention, is something really important to us. But that's a little bit of background on National Life itself. Did Gerson, did you want me to share my screen and we can jump into an illustration? Because I want to look at the expenses here. I know we had some questions there.
Yeah, that'd be awesome. If you can share your screen, go over any of that, and then at the end here, we'll just have everyone like ask questions and kind of free for all.
Sounds great to me. All right. Well, I will share my agent portal here. And so we'll go into illustrations here. I'm just basically going to show you guys kind of the most standard thing here that we do. I can keep it in the state of Vermont, but we do offer living benefits in the state of New York and products in the state of New York. So if you're ever doing business there, we can help you out in that sense as well. So just going to choose Flex Life. As you all know, that's our IUL product. Really flexible, can be built for cash accumulation, protection, whatever the client's really looking for. But the most common one we see by far and kind of the most solid structure you can build to minimize the fees is going to be with minimizing the death benefit. Is there an age that you guys would like me to quote on this?
Uh,
45.
yeah, I think
All
45
right.
is pretty standard.
Awesome. All right. Yeah. And I think you guys can see my screen there. So I just have a 45-year-old client by default. Quick tip in here too. If you ever see these caution signs, you just need to have the client's actual information in here to then start the e-app right from your portal. So if we just change a couple things in here, that will go away for us. And then we'll be up and running. So death benefit and funding, by far the most common thing I see from Family First is this design here, where we just come straight in. Do we want, let's say, $1,000 a month in budget? Go higher or lower if you guys want. But let's have this client paying for 15 years here. This isn't necessarily going to be a comprehensive illustration training, but we wanted to make sure we covered some of the questions you might have on expenses. So by minimizing death benefit max cash value and then choosing an increasing death benefit, this is going to be the way that we get the lowest death benefit and therefore the lowest costs relative to that premium we're paying in. So that means more of your client's money is going into the accumulated value, more of it's being indexed, more potential to earn. What can be really helpful here too, if you want to show the death benefit option changing from increasing over to level, that can make sure that you're actually minimizing the cost even more. Because at that point, you're going to keep building the cash accumulation and lower the amount of actual insurance that you're paying for. To do that even further, we could actually choose this max face amount reduction. It will lower our face amount, um, but in turn, it lowers our expenses. So here, what I have is starting at a $205,000 face amount. We're building cash value over these years. And at this point, it levels out. So now we're no longer increasing the insurance. A great reason to do that is now we're just going to be having all the cash accumulation to decreasing the total net amount at risk, which is how we charge based on cost of insurance. Max face amount reduction will decrease this even more. So now we can see we go down from a $456,000 death benefit down to $362,000 death benefit. So again, we're just having lower costs, and you can see the cash accumulation in this is incredibly strong going forward. If we want to ever, if a client's ever questioning us, what are the expenses in here? Can you show me what the expenses are? We can pull that up right here in the report section. One nice thing is we have everything checked off by default that you're required to have in here. So you're not going to be able to uncheck anything that's required by any state that you're writing in. So we've got some safety nets, some guardrails there for you on that. But if I just check off this policy charges and expenses box, I am able to run my illustration report, and we'll actually have a page that's going to show us the cost breakdown of this policy. Now, you won't see us quoting any percentages on these costs because really with this product being very flexible, there is no percentage that we can quote. It's all going to be relative to the death benefit and the cash value in the policy. So you might already all be familiar with this section. So Gerson, if it's all right with you, I'll just go down to our policy expenses page.
Yeah, that's perfect.
And if there's any questions on this, like Gerson said, honestly, it's go free for all. Ask me any questions that you might have. I'm here for this whole webinar, so definitely just let me know. And feel free to interrupt if you have questions. So we're going down. We are illustrating.
I
I
have a
want to point
question.
out we're illustrating a 6.44% illustrated rate. That is relatively conservative. So the illustration here, what I can tell you is this is not going to happen on paper, but we're showing something that's actually lower than a lot of returns that have happened in recent years. So doesn't mean this is going to happen. It's just a long-term moving average that gives us this 6.45% illustrated rate. And sorry, did I hear a question there? Okay. Oh, perfect. That's gonna work better. Thanks, Gerson. So when we get down here, actually in this case, I did notice we actually have this as a guaranteed no lapse. So pretty impressive that we're able to have a guaranteed no lapse on this IUL, and goes all the way out to age 120. This guaranteed section, I just want to clarify here, this is the absolute worst case scenario. This is the client's index value not performing at all. So there's no interest credited as a result of indexing. So worst case scenario on this, we're going to have it last all the way to age 120. And then down here, this is what our current assumptions are. And then just if we were to get the fixed strategy return. But without further ado, explain the increasing will lower the cost of insurance. Yeah, so great question. Let's cover this before we get into the expenses here. So as we build up, I'm going to go to the first 15 policy years here. As we're building this cash value, as this is increasing, day one, we have 205,000 of insurance because as the client pays in the first premium, there's most of that policy is made up of amount at risk for the insurance company. So if your client were to make a claim on day one of having the policy, they're paying cost of insurance on this entire 205,000 of coverage. So what that means is that is the basis of all of our expenses here. While your policy is increasing in value, the difference between their cash value and the death benefit will always be this 205,000. So that means as they get older and their age increases, therefore the cost of insurance increases, the face amount that we charge that cost of insurance on is the same. So the cost goes up every year on that insurance. As a result, we're getting a smaller death benefit. But then at this point, now we have a higher death benefit $456,000. But as you can see, the difference between the client's cash value and the death benefit is still the same. So now we have a 59-year-old with the cost of insurance based on this 205,000 instead of a 45-year-old. So the costs on this are higher, but now we're able to reduce that face amount, or if we just level it out, as this cash surrender value increases, now that the policy is level, we're actually decreasing this net amount at risk. So the cost of insurance that the insurance company is charging is now lower because more and more of that death benefit is made up of the client's own cash value, which we're not charging cost of insurance on. So if we go down and any other questions we can get to and address in the policy charges and expenses section. So after we have this report ran, it'll be at the very end of our illustration here. So the premium expense charge is the first thing in the column here. We have all the expenses laid out in this column, and notice it's dollar amounts. So this is all based on this 205,000 for a 45-year-old standard non-tobacco. And now we're basically that premium expense charge is the cost of having the premiums go into the policy. It goes for the first 15 years. So as we're paying in premiums, the cost of insurance, this is what I was referring to as increasing as the net amount at risk. So this 205,000 stays the same for 15 years. The policy fee, that's just a built-in fee that's on every policy. That's the cost of doing business. And this expense charge is really largely affected by the agent commission that we pay. So accumulated value charge, this is going to be the cost of indexing. So you're paying this, and as a result, you're getting participation in the index crediting strategies. So now we show here, these are all the expenses that we're charging. And then this is based on the illustrated index performance, what we would credit to the policy. So as a result, we get the total accumulated value minus the surrender charge, which is not really this is only a charge that would come into play if the client were to surrender the policy. But the amount they have access to in the form of loans and withdrawals is going to be this cash surrender value. You'll notice that those are the same starting in the 11th policy year. So that's when the cash surrender value, surrender charge is eliminated from this policy is in policy year 11. Any questions on these the charges and expenses on the IUL so far?
Yeah, so I know when we put the balance sheet benefit rider on, can you explain how that affects our commission and affects the cost of insurance for our clients?
Yeah, great question. So it's actually not going to affect the cost of insurance on here. Rather, it's just going to affect the agent commission and the surrender charge.
Mhm.
So with balance sheet benefit rider, it's a little bit of a tongue twister, but if you've got this selected, you can choose to either waive all or some of the surrender charge. So if you were to do 50% here, that's going to look a little bit different. 100% just means we're spreading the agent commission out over 6 policy years. So instead of getting that larger amount right up front and then having the next 5 years be a lower commissionable amount, you're going to actually have equal commissions paid over those 6 policy years. So as long as that client is paying premiums, you'll be receiving those. It'll be your commission divided by 6 each year. So the really important thing there to make sure that the client is sticking to the plan here is that they're paying for at least 6 years, because as long as premiums are going in, this commission is being paid. But if we run the illustration report again, we'll go and we'll see that there's going to be no surrender charges. Um, and if you think about really what we're doing here, we're spreading out the agent commission because the risk is higher for the insurance company because now we have no surrender charge. So if the client were to pull out of this policy, which is totally within their rights, we just have to make sure that we're accounting for that cost. So that's why the agent commission is spread out over 6 policy years. But now we can see there's no surrender charge for the entire life of the policy. And the rider itself will see cost of other benefits. So this is, if we add an at cost rider, it will actually pop up this new page, or sorry, this new column for us in the expenses. If you have multiple cost riders, it's actually really nice to be able to come up here. You'll see the individual clients or individual riders charge up here. So we can see this costs $1.76 per month to waive the surrender charge. So that can be a really great deal for the client and the agent. Because if you think about now, you know you're getting a certain amount of commission for the next 5 years. You just have to make sure you're on the same page with that client as far as what the plan is for the future to make sure they're going to be keeping that same premium going for at least the next 5 years.
At what point do you think you would recommend turning that on? For what situations?
Yeah, so that's, you know, it's really going to depend. So actually, the balance sheet benefit rider is named that because in a lot of cases where a business owner is using this, if they want to be able to borrow from their policy and use it as a tax-free loan, that's really where we see this being used most because it's business owners that want access to their money, that it's capital they want to reinvest into their business. So they want to be able to borrow from the policy and not have that limitation of the surrender charge. It could also just be for a client that wants to use it for personal reasons to borrow from the policy. But business owners is where we see it being used the most.
Okay, perfect.
And then I see we got a couple questions in here regarding the risk associated with an increasing death benefit on a policy. And that is a good question too. So let's, I didn't mean to close out of that. Because we can actually see on the guaranteed illustrated values, we're just going to have a little bit lower of cash value here. Because again, those expenses are all based on this initial amount we have. So the 205,000 is what the cost of insurance is on. So really the risk here is that you're not, if you don't get interest credited to the policy, you're just not going to have your cash value grow as significantly. So really similar risks to if you're doing this on a level policy. A level policy, though, as you're paying in and just adding cash accumulation, you're going to be decreasing the cost of insurance on that policy or the basis of the cost of insurance on that policy because you're adding cash value. Whereas here, you're adding cash value, but it just gets added on top of the face amount. So we have the same cost of insurance basis. So I wouldn't necessarily say that's a risk, but you're just having a policy that's being charged based off the same amount the whole time. And then we got another question. So premium expense chart, how much of the premium goes into insurance? So yes, that was the cost of insurance column here is what is actually paying for the insurance on this. So as time goes on, that goes up because the client's age does. One really important thing to note here is the cost of insurance basis. So how we're actually determining what the cost of insurance is per thousand of covering that we're offering. We have never changed that on an in-force policy in our 176-year history. We're really proud to be able to say that. If we do need to increase the cost of insurance basis on a product, we will just come out with a new product historically. So we're not in the business of turning clients' policies around to then cost them more than we showed in the first place. So this cost of insurance basis, while there are, guarantees and you'll see this in any company that you're writing IUL with, they have the right to increase that cost of insurance basis on you. And usually that's not a good sign. Because if they are doing that, it can point to financial issues. And we've never done that in the last 176 years. So being a very financially strong company, one that's our interest is for our policyholders, not stockholders. We're not a privately traded company or publicly traded company. We don't have investors that we're trying to make huge gains and profits for. All of our profits are in the best interest of our policyholders. So while it's not guaranteed, the cost of insurance here, we keep that basis the same. And historically, we've only increased that cost of insurance by releasing a new product when mortality rates and all those things that actuaries have to worry about go up. And okay, so just trying to make sure I get to all these questions here. Okay. Dividing up. So if it's max funded out, I think if you mean like you're doing a max non-MEC premium, so like if the client's paying for a shorter period of time, and they want to pay, say, for example, 5 years, because you can build our product really to meet almost any payment period the client wants, especially beyond like 4 or 5 years. So yes, if the client's only planning on paying for 5 years, but you have that balance sheet benefit rider on, you might be missing that last year of commission if they don't pay in premium. So I think, Savannah, to answer your question, I think that answers it, but let me know if you need further
Yes, thank you.
clarification.
That's what I was wondering because I know like
Okay.
the rule of thumb is like 5, but then you said 6, and I was like, huh, that made me think. So, excuse my daughter.
Yeah, no worries. So, yeah, it's definitely best if you have that rider on for the client to be paying for at least 6 years. And then I see we've got not necessarily a question, but NLG is the GOAT insurance company for fully underwritten. I love hearing that because one thing I actually pulled up here is our easy underwriting limits. So I just have to remind you guys that these products, which our average client is in their upper 30s, you can get up to 3 million of coverage on that client with no medical exams, just answering questions on the application, and then 2 million on the term, which I have to remind everyone as well. That term includes living benefits. It includes all the same living benefits we have on the permanent product. And that's where having this ability to do it is going to get your policies issued faster and the client's policy in force faster, and you as the agent paid faster so you can reinvest that into your business. We actually do have, it's around 30% right now that are auto approved, which are going to be the fastest ones to issue. So I do have some tips here that I'm happy to share with the team as well on how you can make sure your policies are as likely to be issued and approved automatically as possible. So this is just as far as underwriting goes. If you have anything in this red column, you're going to want to send it elsewhere. We are definitely not a last choice carrier as far as medical concerns go, especially because we're offering those living benefits. There are just a little bit more restrictions here as far as these issues. So we pulled out kind of the most common reasons that we see declines, the ones that are definite declines, and we put it on this sheet here, which I'm happy to share with your team after this. But then these are kind of things that might require a little bit more time for underwriting. But it's really important to note that in a lot of those cases, we're still able to offer coverage with living benefits. So a little bit extra time, but you're still getting a very high quality product. In this green column, this is going to be your easiest straight through underwriting, and the quickest to issue are going to be people like this. And then we also have best practices on that. So I can make sure I share that with you all after. But okay,
Did
let
I
me
did I
give.
just see you can get someone approved with HIV?
Yes, you can. So actually, if it's undetectable, I know for sure we can get it approved in that case. Um, and if it's moved over to AIDS at that point, though, that would be uninsurable. But if they have HIV, yes, we can consider them. Um, I know they can't get above a standard rating on that, but our underwriters, so that's where it's going to be a little bit over my head in terms of what we require for that. But it's certainly possible. And if you have a client that has HIV, it's good to know that we can offer coverage for those
No
clients.
shit, dude. That's sick.
Yeah.
Nate, can you break down the term side of things and how you can actually convert that term into an IUL? Because I feel
Yeah.
like that's something that most people don't know. Like other companies have term that will automatically roll into whole life, or the option to obviously roll it into whole life. But from my understanding, which is why you guys are the GOAT, you guys are the only insurance company that allows a term policy to actually be rolled and converted into an IUL within a set specific period of time. Can you kind of go through that?
Yeah, definitely. Thank you for asking. So, the term product, I'll just pull up an illustration here so we can have a visual thing on it. But it's convertible to any of our permanent products. So a few things you might actually not know about that is convertible not only to our IUL, but to our whole life as well. And we even have a survivorship product, which covers two insureds and pays out after both of them have passed away. So if you come across a case where somebody has a huge estate and they're trying to make sure that that's covered and they're not paying as high of taxes on it when it goes to their beneficiaries, that might be something where our survivorship product comes up. Now, this doesn't come up very often. I've been with National Life for almost 3 years now, and it hasn't come up too many times for me. But for your really large cases, that might be what a client's looking for. You can convert a term product even into that. So even having two insured, so if you have a husband, wife now that are just starting with term, but you're their lifetime agent, you're their go-to because you helped them out that first time. In the future, we can convert that over to our survivorship product. And we won't have time to go over that full survivorship product today. And it is pretty niche, but I'm happy to come on in the future and definitely go through that more. But just to emphasize what you're saying even more, Cody, there's a ton of different ways you can get out of this term product into permanent. So I see it as a foot in the door to permanent insurance. Plus, you're not losing a ton when you have this because you have all those living benefits. So we can convert this over to permanent for up to 20 years from the issue date. Whatever rate class your client has on the term policy is what they'll have on the permanent. So that means if your client's really, young and healthy today and they get this elite non-tobacco rating, even if they become uninsurable in the future, they're able to convert that guaranteed over to any of our permanent products. As far as running illustrations for that, it's really just going to be a permanent product. So let's just say this client we'll we'll do one of these. So we'll say this client's 25 years old, elite non-tobacco, and from there we jump right in here. Now we have a term conversion illustration. Simple as that. So you're just doing a new product illustration, whatever product we have out at the time. Going to be either an IUL, whole life, or a fixed universal life. Any of those are going to be available, and you can convert. They just keep the rate class they have, and it's all based on them starting that product when the conversion happens.
Would it be based
So,
off the original
yep.
age they got it on too?
So that's a really good point too, because it's not. It's based on the age that they convert. So the sooner they convert, the better those costs will be, and the sooner they'll have money going into indexing to work for them over time. Because as we know, time value of money is very important. So the longer that money can be working for them, the better. And that actually brings up something that I'm surprised I almost passed over, actually. So this, we offer partial conversions. This is something that's not going to be in the client's contract, but it's a partial conversion. So say this client has 500,000 of term. We all know that converting that over to permanent might be a big step in cost for someone if you want to convert all 500,000. But if a client wants to convert 100,000 of this over to permanent, they can. So now you could have $100,000 face amount IUL or whatever amount. If you wanted to just do like a minimum death benefit max cash value, you can rip that chunk off of your term and keep the remaining term in force. So you keep the same amount of death benefit coverage, but now you have this portion of life insurance that has cash value earning for you based on indexing.
So instead of like 500,000 term, you could have 400,000 term, $100,000 IUL essentially is what you're saying.
Exactly. And then as their budget increases more and they have more room for premium into the IUL, they can convert, say, another 150,000 over to Flex Life. Now they've got 250,000 term, 250,000 max funded IUL.
That was gonna be my next question is can you can structure the IUL, fully, even if you roll over, let's say 50, 100,000, you can just minimum death benefit, whatever, just illustrate it and then just roll that exact amount of death benefit over.
Exactly. Yeah. So
That's
on this one, for example, like let's say at this point we wanted to do, because where's this landing us? Let's do $250 a month. So a more kind of conservative number here on the amount, because that's going to bring us, let's do 350 because I want to keep it as increasing. So now we have 70,000 of face amount. So now this remaining term, the cost would go down based on removing 70,000 of cost from the term. So you have 430-ish thousand left on the term and 70,000 of IUL. So that's where that partial conversion just adds more flexibility in my mind to the IUL, because you have that portion that's really just there for death benefit and living benefits coverage. And especially if you're getting the objection of this costs too much, which, like we heard at the convention, if they're giving that objection to you, then it's only going to get more expensive. It's only going to get more difficult to get that coverage as they get older and possibly run into health issues. So if you're met with those kind of objections, this is the perfect product to jump into, because you're not slouching on the living benefits and the death benefit, especially with that conversion privilege. And okay. So this is a question that we get quite a bit. By the way, the team that I work with historically is the 800 number. So if you call in the 800 number and ask for sales desk or pre-sales, if you've called in before, that's the team I come from. And I will say this is one of the most common questions that we get. And it's a really great question because we talk about using these policies for cash value. These policies for cash value and the death benefit. This face amount, this is the amount that is the insurance on this policy. So day one, your client passed away. Even if they paid in $350 into this, their beneficiaries are going to get $70,942. As they build cash value, we're adding that cash value. We're just simply adding it to the death benefit. So as this is building over time, we're showing the net death benefit. The insurance portion, as long as it's increasing, will be the face amount. So to answer your question, they are getting the death benefit and the cash value, but it's not this net death benefit plus surrender value. This net death benefit includes the cash value.
And does that only apply when it's an increasing death benefit? Or can you kind of explain when you'd recommend doing increasing versus level death benefit and like when it would make sense, when it wouldn't make sense to do level?
Yeah, and that's a really good question too, because like it's so flexible that I know it can be a little bit intimidating, right? Because you're like, which one is the right one to do? And the real answer there is just it really depends on that client's goals. So let's say a 35-year-old client here, a lot of the time they're going to be having a family, they want more coverage, but they're also at an age where the cost of having this policy isn't going to be super high. And we're able to, they probably have a mortgage or some expenses out there that they need to make sure are covered in case they pass away. So if they have some term coverage where their face amount is big enough to cover all those expenses, they might not be worried about the total amount of coverage they can get here. But if they don't want to do a term product, or they want to have all their coverage be on one product, this face amount might not be enough. So our $350 here, because we're just doing this minimum death benefit max cash, our face amount is as low as the IRS will allow it to go, while keeping this as with those tax-free benefits. But we only have this much coverage. So we are maximizing cash value. If we look here, I like to usually pick a year like right after our premium stop going in. So like policy year 16, and I use this tool over here all the time. We can see the cash surrender value is 95,492. Really strong cash value there. But if we wanted more death benefit, it's just going to be as simple as doing this. So death benefit option A level. Now we have around $9,000 less of cash accumulation, but day one, they're starting with so much more death benefit. So we've got over $150,000 more of death benefit here. The client's still out of this policy. They are maximizing the cash accumulation, but they're just taking the trade-off of having a little bit lower cash value in the future, because more of it went to pay for this death benefit early on. So it's not necessarily a right or wrong. It just really depends on those clients' goals. That trade-off can really be worth it for somebody that has a large mortgage that they need to make sure is paid off in the event that the unthinkable happens, right? And this helps further answer the question too of whether they get the death benefit and the cash value. So I want to run that expense report again here, because as you see here, we're building cash value, but our death benefit is staying the same. So it's staying the same for all these years because this accumulated value is building within the death benefit. So in this case, I think you're muted, Gerson.
Sorry about that. What was that?
Sorry, I saw you talking. Didn't know if you had a question.
No, you're all good.
Okay, sweet. Yeah, let's look at the reports here because that'll help illustrate this even further. We're building that cash value and you're decreasing that net amount at risk. So that's the part that I was referring to earlier. This 252,000 day one, that's what this cost of insurance is based off of, right? So if the client passed away in this first year, they've paid in after the first year is over, $4,200. The total amount of coverage here is really this right around 249,000, because that's how much between their cash value and the death benefit there is. As we build the cash value in here, the basis of this cost of insurance decreases. So on our increasing policy before, I think we were at around $900 for the cost of insurance at this point, $700 to $900 out at this point, because we had more coverage that was just coming right out of the insurance company's pocket, right? Whereas here, you're actually, a portion of this death benefit is made up of your cash value. So that might sound like a bad thing, but you're decreasing how much your insurance costs when you're doing it this way. So a level policy is definitely going to be more death benefit oriented because you have that higher amount from day one. But as time goes on, you're still decreasing how much it costs. And you actually might get to a point where, like here, we call it corridor, where the cash value is so large relative to the death benefit that to maintain the definition of insurance, keep this with all those tax benefits that IUL life insurance has, the death benefit actually has to start increasing as a result of it. So if you see that start to happen on a policy, you'll often see that on kids' policies in the future. That means the cash value is going so strong that the death benefit has to increase.
I didn't see you turn on the avoid mech, like adjust face amount. Do you
Mm-hmm.
never turn that on, or do you turn it on only for specific reasons? Because I usually always have it turned on to avoid mech and adjust face.
Yeah. So mech avoidance, I usually do not use this because I just keep an eye over here. So it's kind of personal preference on that. If you really want to make sure you have those guardrails on and it adjusts either the face amount or the premiums, depending on which one you're solving for, you can turn it on here. But if I were to say, do this in 2 policy years and we'll do a higher amount here, so it'll actually give us a face amount that will work. Oops, too many zeros there. If I were to do this in a couple years, actually the minimum death benefit max cash value solve, so now I'm remembering why I don't use it. Most of the time I'm using minimum death benefit max cash value. This in and of itself will prevent the policy from meching. So by using that solve, it's actually going to match your premium to either the max non-mech premium or the guideline level, depending on how long you want to pay. So I usually just don't turn it on because if I were to have the policy mech, for example, I'll just do like 200,000 of face amount right here. It'll just tell me right over here what year it becomes a Mac. So that's what I keep an eye out for. But if you're just getting started with this, or if you just are running a lot of illustrations and you really want to make sure you don't even have that as a problem, it will give you like the option to turn on yes, adjust premiums. So now it didn't let us pay in that full amount that we wanted to because it knows it's going to mech the policy. So that's a good control to make sure that you're not going to mech the client's policy no matter what you do with the face amount or premium.
Okay.
But yeah, I typically just keep it like this because also if we do the minimum death benefit max cash, it can error out there. But the nice thing too, like I don't know if we want to dive into like mech and guideline right now, but with this, if we're paying for like a shorter period of time, so like those 5 pay or 6 pay options, we can actually do this. And now we'll see. So we're paying for 6 years, and we'll notice that our premium is actually in between this guideline level and our max non-max premium. So it's shooting the middle, and so it's shooting the gap here to give you a face amount that will be just low enough to fit the premium in for the amount of time that you have, preventing a mech, and also being above the guideline limits. So we can, I don't want to dive too much into that because guideline and mech limits are definitely a little bit in depth into like the IRS guidelines 7702. But the nice thing is that you guys don't have to worry about that stuff because the system takes care of it for you. So that's really the takeaway on the guideline limits here. Okay, awesome. Yeah, and my recommendation in terms of a new agent learning this all as fast as possible is to join webinars like this. So whenever you see these being offered, either internal or through our webinar calendar on the website, we have hour-long in-depth trainings on IUL illustrations, even whole life illustrations sometimes. So definitely great to join all of those. if you can. And then, okay, really good question here. So if a client wants to do a lump sum, it's a little bit of a it depends on how much the lump sum is, right? If this lump sum is going to be like 20 times our monthly premium, it might not be the best idea to do, because in that case, you're just going to have the face amount is going to have to be big enough to fit that one lump sum. And then all those ongoing premiums are going to be relatively low compared to that lump sum. So it really depends. $5,000 here in this case, and then let's say like $500 a month. So now we're going to have $5,000 plus like $6,000 in the first year. Again, we're going to have everything adjust. So it does get more money into the policy faster, and therefore the indexing will start faster. So it can be a good option. But if we were to totally change this around here and say our client wants to put in 50,000 in the first year, we're actually not going to have as strong cash accumulation relative to this death benefit, because now our death benefit has to be so big to fit this 50,000 or 56,000 in year one that our max fund amount, because really if you're paying this over, let me switch it back to 10 years because I don't want to get things muddled with the MEC. But the 10-year payments on this, let's just say you want this guideline level to be what your client's paying. If your client's paying guideline level, that means they're paying in the most that the IRS allows you to put into one of these types of policies, while still maintaining that definition of life insurance that allows you to have all those tax-free benefits. So in this case, we're not actually maximizing the cash value out of this 6,000 that's coming out in form of 500 a month, because we're not even close to this guideline level premium. So as long as your ongoing premium is relatively close to that guideline level premium, yes, it can be a good idea to do a lump sum with it. If you do have a specific case too, like I'm happy to jump on a call with any of you that are working on something like that, and we can make sure we're getting the optimal mix for the client. So I hate to not give a super conclusive answer there, but as we know, every client is a little bit different. So depending on their needs, it can definitely be a good idea to do a lump sum. In this case, it would be, because look at that. We're paying above what we're able to, still not mecking on this. And we're paying above the amount. So now we've got something that's really still maximizing the cash accumulation, even with that lump sum.
And then I got a question as well. So when it comes down to kind of putting in the most amount of money to kind of max out the MEC premium, does that affect the client's cost of insurance, death benefit, or just policy charges at all? Because if I have a client, let's say he's putting in $500 a month and his MEC premium is like 9,000 or so, could he just go ahead and max out the MEC every year?
Yeah. So if it's an increasing policy, the cost of insurance and everything will not be affected by that, because again, we're going to have the same face amount, same net amount at risk for that. On a level policy, the more cash you get into the policy, the lower the cost of having that policy will be. So that generally answers it. But if we were to just say here, let's specify a face amount, so 250,000. And let's see what the max non-MEC premium is. So max non-MEC premium here, 13,962. If we wanted to just say we're going to choose the max non-MEC premium here, so we're going to try and pay exactly this amount for, let's say, 15 years. And now we go to the quick view. So it only lets us put in this premium for 4 years. And then it cuts it off in year 5. And the only reason we're able to pay in these years is because the balance sheet benefit rider. So just to simplify things, I'm going to switch that to no here for the time being. But you might be wondering, like, how did it just decide in the middle of year 5 that we can't pay in any more premium? So this is where, and I'm glad you brought this up because this is kind of a taste of where MEC and the guideline premium limits come into play. So if we add up 13,962 times 4, 55,848 plus 74,112, we're going to get 63,260. So because we've hit this guideline single premium limit, you can kind of think of this as the ceiling in the policy. So within usually around 13 years in the policy, this is the total amount that the client can pay into the policy and still maintain that definition of insurance. So while they can pay in that max non-MEC, they can only do that for a limited number of years before they hit that guideline premium limit.
That guideline single premium is like the lifetime ceiling of the policy.
So not quite the lifetime. And guys, I literally went on the IRS website and read 7702, which is where the guideline premium test rule comes from. I will say it's not logical, but because it's an IRS guideline, right? But what it does outline is the maximum the client can pay into this is either this guideline single premium or the sum of all the guideline level premiums, whichever one is higher. So at this point, to answer your question, they can start adding more premium into it, but we notice it's now limited to that guideline level premium. So now we're just trying to pay into max non-MEC premium every single year. It zeroes out for a while because we hit this limit. But at this point now, the sum of all the guideline level premiums is higher than this guideline single amount. So we can start putting in our guideline level.
Wow, okay.
Yeah. So if you ever want to go, I wouldn't necessarily say it's a fun read for 7702, but it basically basically outlines what we're showing here.
No, that's awesome. I love how in depth you can get with IULs and how complex and how simple like they are to sell and how simple they are to just like give someone a really, really good policy, but then how complex you can get into it if someone really wants to fund the crap out of it.
Yeah, and I think the way our illustrations are laid out too, I heard a lot of great feedback about these at convention. So, and I appreciate everyone sharing that because I live in these sort of things. So it's good to hear feedback from you all actually bringing this to clients that this is really helpful for you because we start off super simple, right? We lay out everything, the death benefit, what the cash value is projected to be, what their living benefits can be. And then if they want to get more in depth and more into the details of it, you just scroll down further and further, and you've got it all laid out for you right here. Plus the definitions in here. I mean, if you ever have a client that's like asking, what does this mean? That like the guideline, like what I was just talking about with 7702, we have reminders built into the illustration report. So really glad to hear that it's helping everyone and how our illustration is laid out.
Yeah, this is awesome. I know I really appreciate your time. It's been almost an hour here. Does anyone have any like last minute questions before we kind of wrap this up? Awesome. Hey, well, I appreciate you, Nate, so much, man. This has been super insightful. I have a few questions here. I'll have to talk to you about that, one-on-one though, because I can keep going on this for hours. But
Wait,
I mean,
yeah,
if you want to drop your number or drop your email in the chat or something, that way people can get in touch with you in the future, that'd be fantastic.
yeah, definitely. I'm doing just that here, and we can definitely connect offline to make sure we get all the questions answered. And in the future, I'm happy to jump on more calls with you guys, go over either more in depth on IULs or we can look at other products that we offer, plus our indexed annuities. If you guys are comfortable with the indexing on these IULs, that's definitely something I could see on the future. I'm confident that you guys can learn that. If you're learning this, you can definitely learn indexed annuities, but that will come with time. So very much appreciate everyone's time here today. And yeah, just reach out if you guys have questions.
Awesome. I have a good idea for the next call when we have you on. It'll probably be like when to pivot over to the flexible premium annuity. What was it called? The Fit Secure Growth. I think that could be something we go over in the future because I had to pivot over that a couple times with a couple clients that didn't get approved with IULs. If like still wanted the indexing, the retirement options, those are super good pivots. So we can definitely do that in the future. But I appreciate all you guys for hopping on. Nate, you're the man. NLG is the GOAT. Everyone should be slinging some NLG policies this month. Let's get after it. And God bless you guys. Let me know if anything. Let Nate know if anything. And so a fantastic Tuesday.
Thanks, Nate the Great.
Thanks,
Nate the
everyone.
Great. All right.
Appreciate it.
God bless
All
y'all.
right.
Appreciate it.